Hi, everybody. Welcome back to the Comstock channel. I'm Marlin Bohling with you. Thanks for joining us. I have Relph with me today, and we're going to talk about some very active market action that took place as we wrapped up the week and headed toward the weekend. Lots to talk about today. Make sure you like this video, subscribe to it by clicking on that bell icon down below, and share it with others too, because we're going to have some very important information that we're covering in this episode. Lots of technical stuff to talk about. The markets were kind of changing directions at times today. Eric, well, let's take a look at the grain markets first, if you don't mind. First
Yeah.
off, you and I had talked earlier today about several markets. One was the corn market. What did you notice in the corn on Friday?
Well, we've had a decent little rally of late, and I'm going to cheat a little bit and refer to some patterns and whatnot. But since we made the February lows, we made a nice rally, hit resistance, fell back. So we came up against several things over the last couple of months. So when we look at the December corn chart in particular, because that's the crop going in the ground right now, I kind of went and dug up what I thought maybe could be a topside objective for now for that contract specifically. And in the nearby, I noticed we've got, going back about 6-8 months, we've got a very defined trend line that we're getting very close to. And that coincided almost perfectly with the 100-day moving average. And I know the technicals don't mean a lot to folks, especially out in the fields, but this is a lot of what the managed money focuses on. So it definitely has to weigh in. At times, we used to say that technicals maybe made up 30% of trading strategy. And I would say that's almost flipped to where, because of the massive amount of cash flow in the managed money funds, it may be closer to 70% of the reasoning behind some of the market moves. So we definitely have to keep it in mind. And so this is set up as perfect for nearby resistance in a corn that's made a nice little rally here recently. Planting season hasn't been the most cooperative. So when we look at the fundamental factors, exports have been good. They've been running into some trouble in South America. Nothing horrible other than maybe that Argentina story develops out a little more. But all in all, how much of that is priced in, we don't know. All we know is we can look at this and say that may be a stopping point on the chart. And we're within a nickel of both of those, the trend line resistance and the 100-day moving average in that December corn. So it's definitely something to keep in mind here.
If nothing else, would that trigger a little profit taking on the part of the funds?
If that is to hold, I think that's a spot where they'll defend. I think they could come back in and add back in some of the shorts they may have liquidated on this most recent rally. If they do defend and win in that defense, then we could see a setback and go back into this grinding pattern. However, if those give way and we do break out above them, then that would instigate some liquidation on their short position that's just massive. That happens, then all bets are off and you're redrawn.
Okay, so the corn market, by and large, this winter has been kind of a sleeper. It hasn't done too much of anything. One that seems to have really woken up here in the last week or so is the wheat trade.
Extremely.
Now, okay, there's a debate over who is the leader in the wheat. We have 3 exchanges, and they kind of take turns. But today on Friday, it seemed to be Kansas City's day in the sun. They took the leadership role, and Chicago for a while was running pretty strong. But you and I had talked earlier today about what's going on in Chicago wheat. That seems to be where all the investment money is. And it kind of did some funky stuff today to wrap up the week, didn't it?
Yeah, definitely notable. You hit the nail on the head with the liquidity in the market. So we've got 3 classes: Minneapolis, KC, and Chicago. Minneapolis honestly probably has the best fundamental storyline, barring whatever happens with weather conditions here over the next 30 days in the Western Plains. So the Chicago being the leader doesn't really make sense because conditions are the highest they've been in a long time. But a lot of traders, especially managed money funds, who don't know the difference of the regions and what classes are grown where, they just trade wheat, and the Chicago is the most liquid, so it draws all the attention. Anyway, that aside, today's trade in the July Chicago, which is first month new crop, so it's like your December corn, your November beans. July Chicago wheat traded sharply higher over the last week and a half. It put on almost $1 on that contract, and today traded right to the 200-day moving average, which as we look at that chart, I've got that on a blue line. And I want to draw attention to a few things here. that blue line was basically the high of the day. This chart was pulled actually right before the close, so the close actually settled back off of that a little bit. That also got very close to our next retracement level on the Fibonacci retracement mark, which is indicated by that red line just above us. So could we take it out? Yeah, we could. Technically, I don't think there's a reason to. This should attract some selling pressure, especially when you look down at the bottom of this chart on the stochastics oscillator and you see that it's just about as overbought as you can get. I think the stochastics are up around 98. So it's well due for a reprieve. And I would expect to see that, especially in that SRW class that really has a good fundamental storyline for the crop.
I was looking at a Kansas City wheat chart on July, and it looked very similar to what this one does.
It does. However, like I say, conflicting fundamental stories. So you've had some severe weather move through the Western Plains. Now they still have time to do something else with that ground. So if it happens now, they can get to moving. And I've seen it happen in real time where a hailstorm comes through. You're getting the adjuster out just as quickly as possible so you can start ripping ground and getting something else in. Usually it's Milo or something like that. But they still have the opportunity to do that in the severe weather instances. However, the next few weeks goes by, that gets behind us, then we're talking about what's the moisture level been like, what's the temperatures like, because they're already drying up to a point where they're going to start struggling. The plants got too mature too fast and then ran out of gas. And if they don't refill the tank sooner than later, they're going to be in trouble.
Now, of course, in the market, it seems like worldwide, they have the attitude that rain makes grain.
Yeah.
Even if the crop is dead in a lot of areas.
Right.
They hear rain in the forecast and they think, well, it'll get much better now.
Yeah.
Is that still the case?
Oh, sure. Yeah. You can have all the seed in the bins that hasn't even been put in the ground yet. Rain makes grain. They don't know the difference as far as the general population of the market. But this is a scenario that could be really interesting, especially if these next lines of systems move through like they're supposed to. You're talking multiple inches on ground that's just been planted. You're going to have issues, especially where it comes down hard and heavy and stays low lying areas. You'll be talking about replant, prevent, plant. This could lead to a broader storyline, something we haven't seen since the 2019 season.
Well, I know, I believe Comstock actually put out an alert to their subscribers, didn't they, related to the wheat on Friday with the market action?
Mm-hmm. Yeah. This has just been a sharp rally, and we wanted to clean out bins and get rid of this old crop and get ready for the next year.
Yeah, so another advantage to the folks that have subscribed to our information out there. It's always a beneficial advantage for everybody that does that.
Sure.
Okay, so talk to me about soybeans. We covered the corn and we covered the wheat. Soybeans kind of got lost in the shadows here on Friday. How come?
Yeah, well, they're just lazy. They can't figure out what to do, and that's true of the products as well. You would expect to see meal and oil rally from these price levels. I understand the story in meal. Argentina's coming online with their soybean crush, and they export meal, and that's their thing. And so I can understand the meal not really getting legs, especially when we're crushing domestically for the extraction of the oil. The meal becomes somewhat of a byproduct. So I don't know if those values will ever recover to levels that we've seen in years gone by. And I think the old adage that a meal rally is a real rally might be a thing of the past, because I think now we're going to have the oil participate. And right now, the oil is not participating. The only hope we have is that the push for renewable diesel will drive the demand for the soybean oil. They figure out the logistics, they get that process moving a little quicker. Then we have an increased demand rather than increasing stocks, which is what we saw in the last NOPA crush report. We've got to get those stocks under control, get the usage figured out, get the logistics figured out, and then maybe we have something to stand on. But right now, all we know is that Argentina compensated for the lack in Brazil for total bean production. Argentina is now actively crushing and shipping their meal. And we don't really have a reason domestically to think one way or the other yet, because it's too early. All we know is that we still got time to get the beans in the ground. So for now, it just sits there.
You talked about a rainy spell in the plains and Midwest here for a few days. It's a little early to sound the alarm bell, isn't it, for delayed planting concerns? Generally, I believe Comstock had put out some information here a couple of days ago that historically you really don't see too much of a yield loss, at least in corn, until mid-May. Is that right?
Mid-May is when it becomes an issue. That's right. That I referenced 2019. That rally started, and I may get my date wrong, but it started right around the middle of May. 13th to 15th of May is when that actually starts. So that's, obviously past performance is not indicative of future results, but it's the only thing we have to go by. So we go look at the history, and that was the last real planting weather rally, and it didn't start until that mid-May timeframe. That's when the trade's going to start to get concerned. Now, here locally, I look at our extended forecast, and that could be a time of concern for us. So, a lot to figure out, but this is interesting for now.
What about the impact on beans if they get delayed?
It'll be the same situation. If this turns into an all-out delay, if everything ends up delayed because of wetness, and then you start talking about prevent plant issues, beans, yeah, they're more tolerant, but this is still the bulk of the growing regions in the US. They still have a window they have to fit in. And if that window's starting to close, the market's going to react.
And I did hear some forecasts talking about temperatures getting up in the 80s, maybe even 90s in the far south. So maybe that'll help rectify the problem a little bit. On the other hand, you and I both know, coming from the plains, if you get a lot of hard rain and you get a couple of sunny days on that, it can turn into a brick too. So
Absolutely.
if you have clay ground, that can
There's
be a
going to be
problem.
there's going to be a rush on rotary hose, I have a feeling.
Right. Yeah. Yeah. You know that too. Let's talk about livestock then. Start of the show on Friday. What? Feeder cattle ran away with it, huh?
Feeder cattle ran away with it on Friday. The cattle complex traded beautifully this week after gapping open on Monday. From a technician standpoint, this was just picturesque. And so the first one I want to look at is the May feeder cattle chart. And I know, again, we're being overly technical, but we talk fundamentals all the time. And I think once in a while, it's good to turn our head and look the other direction and see what's coming from that way too. But to start this week, you had a gap open in nearly every cattle contract, that being true of the May feeders as well. So you gapped open, traded higher, had follow through on Tuesday. Then on Wednesday, came back, filled that gap, which is, like I said, picturesque. It was perfect right there. You filled it next day, turn around, shoot higher, follow through on Friday, finish the week strong. You've got a weekly bar that just is beautiful. The setup is there. However, I would caution that when you look at some of the lows that we set back in the first quarter, particularly in that late February timeframe, we're getting awfully close to those. And so we need to be cautious of some of these other resistance levels that we could be running into. And, profits will be taken. So we have to be cognizant that, okay, when it has a big run like this, like what we've seen since making the low, we need to be ready to react if long traders decide to, especially speculative longs, decide to take some profit.
The live cattle charts look a little bit different, though, don't they?
Live cattle look a lot different. We actually already achieved some meaningful resistance especially in some of these deferred contracts. The one that I was keying off of, and I had no idea how significant that was going to be. We talked about this on Wednesday. I said I wanted to see those fourth quarter live cattle fill the gaps that were left on Monday. The very next day on Thursday, December went down, filled the gap by one tick, reversed, had an outside or had an upside reversal, finished the day sharply higher, then caught follow through today. But today took us right to the 62% retracement, which also took us back to the January lows where we kind of spiked down there a couple days in a row. So there's pause for concern in here. The market looks healthy. The fundamentals look good, but we can't just blow through everything like it's not there. And there is reasons to think that we may struggle here a little bit. We got to get some outside money coming in, some outside interest to perk this thing up.
But you can't have too much divergence between live cattle and feeders, can you?
No, you can't. I mean, feeder cattle are just a derivative of the live cattle. And ultimately, the live cattle are going to dictate what the feeders do. The live cattle are dictated by the cash market. So it all comes back to cash, which we did see improvement this week. Actually, widespread $2 per 100 improvement. I had both dressed and live trade up $2 at 184 live, 294 dressed on the weekly averages that we've seen so far, and maybe we'll get some surprises to end the week. But I did have one client here in Northwest Iowa sold at 295 dress, picked up on the farm. So that's pretty impressive trade to finish the week here.
So if live cattle can't take out the overhead resistance, it's pretty close, like you said. That would make it a pretty heavy lift, wouldn't it, for feeders to keep going?
Absolutely. The only thing that could negate some of that is if the market participants are still hot after these heifers. Right now, we're starting to see signs that we're trying to rebuild the herd, and that's something that we hadn't really seen very strong signs of until lately. And so, if they remain hot after heifers for replacement purposes, then that could keep the barns hot. And even though the feeder cattle index is based off of an 8-weight steer, well, technically a 7 to 9 weight, but 8's in the middle, right? Even though it's based off of steers, if the auction vibe is hot, the steers are going to bring more money too. And I hate to think that people are going to be paying just outlandish prices for feeder cattle, even if the fat cattle market doesn't coincide. But that has happened and does happen.
Well, let's kind of turn things upside down a little bit and talk about lean hogs. Now, you have a graph that you had printed out that's related to the lean hog chart. It looks like we're looking at a June contract here.
Yep.
Now, here, it looks like instead of testing overhead resistance, it may be testing support on the downside.
Correct.
Explain what we're looking at here.
Yeah, so this is the June lean hog chart, and this is going back about 6 months. But you can see back at the first of the year is where we kind of made some lows, and we have a really nice defined trend line here that we are testing today, or we were testing today. We didn't finish far off the lows, so we're still down in that neighborhood. So the takeaway here is, each one of these bars is a different day. We're one down day away from breaking that trend line support. And if you look down at the bottom in the stochastics chart, it's not oversold, it's not overbought, but it's not oversold. It's just right there in the middle. So definitely room to fall there. And this is something to keep an eye on because, just recently we went back to retest highs. On Tuesday, we were trading awfully close to contract highs in June, July, and August, within $1, $1.50, depending on which contract you were looking at. And so the question was, are we going to take these highs out? And I think you remember when we were having that conversation, we thought if we don't close above those prior highs, then this is a market to stay short. So far, that's been the right decision. If that trend line gives way, then we've got a whole nother problem on our hands. And hopefully people have some protection in place.
Still looking at the June chart here on the hogs. I heard quite a bit of talk earlier this week about concern of a double top on that chart. And that's pretty obvious right there. Is that a thing in lean hogs? Do they tend to do that?
Yeah, and doubles will hold. They'll, you get up, you test highs, sometimes to the tick. It doesn't always have to be to the tick, but it depends on the market. This I wouldn't qualify as a double top, but we were getting eerily close on Wednesday, Tuesday, Wednesday. But we failed prior. So does the failure continue, or do we go back up and make another run at it? And both are quite possible. Hogs can move and not really have any reason why.
Other items in the news as we wrapped up the week, economic news. We had several reports out from the government that said, well, inflation is still alive and well in the U.S. Now what? It doesn't look like the Fed really is going to have much of a chance to reduce interest rates.
No, they're not. I mean, now you've got your CME Fed tool talking maybe one cut this year, whereas it had something above an 80% chance of 6 cuts for this year when we came into the year. I would be surprised if the likelihood remains for 1 cut, honestly. This information, although, everybody talks about it, everybody's concerned about it, but we're obviously not slowing down our consumption. We're still spending money, we're still buying. And as long as they feel like the economy is moving hot, they may continue to cut out and could possibly even increase interest rates. I wouldn't say that that's an unlikely possibility moving into next year. So, all the financial instruments are trading in a bit of a scared manner. You start to see some erratic trade in metals, equity futures, the dollar itself, and it's an election year. there's just a ton of stuff here. We don't know what our relationships with China are going to play out like. We don't know what their economy is going to do. And I think you're seeing that in the trade.
Well, and that leads me to my next question. I'm glad you brought that up. If you get investors that are kind of spooked from the equity markets now, they didn't have a very good week. Would that mean that you will see a lot of that money get diverted into commodities now?
Oftentimes it does. This is one of those scenarios, though, where the commodities, until very recently, commodities hadn't been performing all that well. Then when you catch a rally in crude oil and metals at the same time, those are major markets. They weight indexes, whether it's the Bloomberg or the CRB, whatever. Commodity indexes are heavily weighted to energies and metals. So when you have both rallying, and you've got all-time highs in some of these other markets or close to it with regards to cocoa and coffee, which factor in, our basic core U.S. ag products don't necessarily have to be beneficiaries of a commodity rally. And so I think this is something that we have to analyze from a pertinent standpoint. If we do see a rally in commodities, does it benefit producers in the U.S.? Does it benefit the bulk of our direct clientele? Right now, I don't see signs of it. Eventually, maybe you see some money spill over, but the biggest thing would be if we could get funds to take profit on these short positions.
I did want to ask you just real briefly here, and maybe this is out of your wheelhouse. I know I've heard you guys talking in the past about noticing the rice market, that it seems to be trading so high. And I noticed that the nearby contracts are just far exceeding the deferred contracts on the rice. It's really front loaded.
Yeah.
Is that offering any indication as to maybe some action that needs to be taken there?
Well, from a technical standpoint, that chart's just begging to be sold. And I mean, it tried and failed to make a new high this week. And so you're going to find some technical pressure when you do that. However, I will add, I spent some time in the Delta with Comstock, and we have several contacts there. I've got clients there, and I talked to a few, including a miller near the Mississippi River, and they said there's just no rice. So when you look at a spread between old crop and new, say you look at the July-December spread, or July-September even, that close together. Well, they're separate crop years. Even though the rice doesn't get out of the field and milled and out onto the market in September, it's not real. It's still the first month of new crop. So you have a huge spread between the two, but they are expecting a good crop. It's definitely wet. The thing I could see hurting rice, though, is prevent plant.
Interesting stuff. Eric, thanks for spending some time with us here. I know we covered a lot of ground here on a Friday, but very important stuff. Thanks for pointing out all the technicals that we need to be aware of.
Yeah.
Great information, and hope you have a great weekend there, sir.
Yeah, you do the same, Marlin.
Eric Relph with us. He is with Comstock Investments. That'll do it for this episode. And we certainly do wish you a good weekend as well. For producer Brian Hendrickson, I'm Marlin Bohling. We'll catch you next time on the Comstock channel. Thanks for joining us on our Comstock YouTube channel. Don't forget you can also find us on Facebook and TikTok as well. Futures trading involves risk. The risk of loss in trading futures and or options is substantial, and each investor and or trader must consider whether this is a suitable investment. Past performance is not indicative of future results.